Yuri's box. In this video, I'm going to talk about TLT, the long bond. If this is the sort of content you like, consider leaving a like, and I'll jump right into it. So we've had CPI just get published a little under an hour ago. And if you're someone that follows the markets, you'll know that it wasn't a pretty picture, to put it in modest words. But in this video, I'll try to make an argument why it pays to. I think it pays to be optimistic about inflation going forward, especially during times where it's really, really difficult to be optimistic. So, really, ever since the summer, beginning of fall, markets in general have basically done nothing. Yes, we've seen some gains, but nothing really dramatic. And I argue that goes hand in hand with the labor market data that we've had ever since the scare in the summer. Every print has been labeled like the print that will settle all debates. Are we reaccelerating? Are we, is it 1929 depression? Where are we? And every data point so far has been all over the place. You could find things to tell you that things are breaking down. You can find other data that tells you inflation is gonna run like in the 1970s. So really, it's really difficult. It's been really difficult to come down to really a precise picture of where the U.S. economy is at. Now, I'm going to share what I like to look at. You could say what does an amateur look at, and I'm going to look at, and what I do look at is actually the quits rate. Now, why do I like the quits rate? The quits rate is, the way I treat the quits rate is, first off, it's my favorite number that comes out each month. And because it is basically a survey of not people's thoughts and intentions and words, rather. It is a survey that tells you what people are doing, and it removes all of the noise. Like, let's take what I think is its best competitor, the UMich consumer survey, and what basically got released this week. We had a big scare again with inflation because expectations were 3.3 and it jumped to 4.3. But then you kind of peel back the onion and you see that, why did it jump up? Well, simply put, Republicans see inflation expectations unchanged, but Democrats, as the article on here on Zero Hedge writes, Democrats have basically, they flipped, even as the picture down below here can tell you. Democrats are basically expecting worst case scenario. Now, this isn't a judgment on whether Republicans are better at predicting where inflation will go than Democrats. I'm just making the argument that these kind of surveys are not that good because they tell you what people think, and what people think is skewed by, well, as you can see, political bias, and anything really. You see something in the news that can potentially affect your opinion, and that can cause all kinds of results in this sort of survey. So opposed to that, you have the quits rate. And what does the quits rate do? It tells you what labor market participants are actually doing without all the noise. Whenever you have the quits rate at cycle highs, that is a pretty good indication that labor market participants are definitely confident. At that point, what labor market participants are telling you is that right here, jobs are plentiful and they hold all the leverage when it comes down to compensation. Why? Well, if they believe that they can get another job, i.e., by quitting, they'll basically do it to get a bigger salary increase. And they can use that very well against their employers. You have, put it simply, employee goes to employer and says, either you fork up, dish out, I don't know, 6% increase on my wage, or I'm changing jobs. And that's what exactly we saw. On the other hand, when we have quits drop to the very least cycle lows, it kind of entails that things have changed quite a bit. Employees no longer enjoy the leverage when it comes down to compensation. They're definitely feeling the pinch, and they are definitely acting more defensively because they're not, going out and acting all cowboyish, being aggressive. They're really just saying, I'm going to stay put. Forget about wage increases. I want to keep the current wage I have because it's scary out there. Okay. And to go along with that, you have weekly hourly earnings. Wages, here we go. Oh, not this one. Average, sorry. Total private. And that as well is basically telling you the exact same thing. The number of hours has been, well, basically cooling, let's put it like that. And that, generally speaking, on a historic basis, is never good news. I'm not going to go into my views on layoffs. I'll probably leave that for another video, but this kind of leads layoffs. So what job quits are telling you really is that you don't have a consumer that's really ready to put up a fight. It's all about keeping what you already have. And another reason why I like the quits rate, you kind of saw it before, is of course because it is very nicely correlated to inflation. Wherever the quits rate goes, generally speaking, inflation will follow. Now, it is true we've had, generally speaking, not good news come out of the CPI prints ever since September of 24. But as you see now, of course, it's not perfectly correlated, but it's pretty close. And what you'll see is that around the fall to winter timeline, we tend to get a bump, both in job quits, where they either, have a slightly tick higher or stay flat, and inflation basically do the same thing. It's been fairly consistent throughout this cycle, and we'll look at it on the way down. So after 2022. So what happened in October of? Let's see what happened in 22. So in 22, starting really, you can argue July, but September to December, it was really, really small, and of course, inflation was really coming down. But you could argue now this is a bit iffy. All right, I'll give you that. But we did kind of see a tiny bump. All right, that is more evident in 23. November 23 kicks in. We have quits rate staying basically stable, and inflation starting to tick up again. And that lasts until March of 24 of last year, before eventually following it. Now, it's important to note that quits rate is 1 month behind. So this data point is for December, while this data point is for January. At the same time, though, don't really look at the level, look at the trend. And what consumers are telling you is that the situation in the labor market has cooled. We're not dealing with the labor market of 21 and 22. And, well, you could also argue 23, although labor market revisions by the BLS have kind of, poked holes in that. But still, let's give them the benefit of the doubt. We're not dealing with that anymore. And arguably, the seasonal bumps we've seen in 23 and in 22 have not only reoccurred as we're speaking, but they've actually been aggravated by factors that have pretty much nothing to do with Fed policy or anything that we can control. And yes, I'm also pushing aside rate cuts, and I'll leave that for another video. But what really happened in ever since August, September of 2024, we've had events that have been, incredible. Like, if you think back to August, we've had port strikes where, if you are a retailer and you see that you have potential port strikes coming up in the following week, in the following months, what are you going to do? You're going to make sure you have everything stocked up before any potential strike, because you're not going to miss the holiday season. You don't want to miss that, so you want to make sure you have everything. So you had the port strike scare in September. Then you had incredible natural events such as hurricanes in October, and basically half of California going up in flames in December and January. And on top of that, you've also had tariff fears, which of course I won't get too deep into it, and I'll leave it for another video as well if I feel like making another video. But anyway, we've had, not only have we had a seasonal bump, we've had things that are completely unpredictable and totally independent from policy. Now, of course, that excludes tariffs, of course. But that's just to say that we've had things affect the numbers in CPI, because of course, if things get damaged, there's going to be people are going to spend money just to fix their house, buy a new car, used car, all of that good stuff. So I take it back to the quits rate. As long as you see people telling you via the quits rate that the situation in the labor market isn't getting any better, I remain optimistic on inflation. And I think that throughout the year, that will leave room for rates to come down Now, by how much, I don't know. Again, there are a lot of things that can happen, as we've seen with hurricanes and other apocalyptic scenarios. But again, it pays to be optimistic, especially when it's really really tough to be optimistic about things. And I'll tie it back up to TLT. Obviously, inflation is a killer for bonds, and as you've seen today, it's we've had a what's this? Well, 10 basis points move in the 30-year and the 20-year, which isn't pretty. And before I go any further, trying to pick the bottom in bonds is being a fool's errand. It's again really you would have really been better off in anything else except bonds. However, I do believe that since the message that quits rate is telling you that things have cooled, and I think they've cooled more than what is current consensus. And since profit is made where there is a differential between um, expectations and probabilities, I'll take the under when it comes to inflation, and I'll choose to be optimistic simply because people are not acting in a way that would lead to um, the sort of inflation we've seen in 2022 and 2021. All right, so hopefully I made a good job of explaining why I'm optimistic on inflation. And just to wrap it up, TLT has been doing nothing but bleed for the past 3 years. Arguably, if you want to get, if you really want to be optimistic, you could say that there's a bullish divergence playing out on the chart, with the RSI putting higher lows and with the price putting in lower lows. But apart from that, it's it's definitely not a pretty picture. Now, I'm not gonna call the bottom in this video, and simply because it's been like first this was the bottom, then this was the bottom, now this is the bottom. Oh no, wait, it's not the bottom. Inflation is gonna derail all of that. But if you simply just look at the chart and you look at the history of you know of bonds, what do they like to do? So first things first, double bottoms. This chart is double bottoms galore, and you really have two types of double bottoms. This one, like in 2010, where it kind of puts in a slightly higher low before having a sizable rally, or this one here in 2000 and the 2008 cycle, where it puts a slightly lower low. Now, could this be the 2010 example or 2008? Time will tell, honestly. I'm pretty patient. I don't use leverage, and again, I'm a patient guy, so I have absolutely no rush. But I do believe that there's an opportunity in bonds, simply because historically, the best time to buy bonds has been precisely when nobody wants to touch them. When nobody wants bonds, generally speaking, that is the time to start nibbling away at bonds. Now, again, obviously not financial advice and all that good stuff. That's a first for me in the NFA world. But at these levels, rates are compelling for the simple reason that we are back up at levels. Take the 20-year, for example, at levels seen in not since 2022. Without the growth and the strength and the heat in the labor market of 2022. And that's true across the curve. And while it is true that we have a problem with inflation, I'll also argue that historically, inflation has been a terrible measure of where rate policy should be. And I'll just take the last three recessions, excluding the pandemic. I've highlighted those in yellow. So let's take the first one, 2008. Inflation just before, I mean, not even just before, in the lead up to one of the worst crashes in history. Now, of course, every time has been different, and every time will have its own peculiarities, granted. But if you let inflation tell you where rates should be, you're really looking in the rearview mirror. I'm sure you've seen plenty of articles, and that is actually a pretty good exercise in your free time. Go back and look for articles in Wall Street Journal, whatever, and look at what they were saying in the lead up to 2008. Right? Look at what they were saying after January of 2008 when the Fed cut rates, by, if I'm not mistaken, nearly 100 basis points. Yeah. Yeah, nearly about 100 basis points. You'll find that a lot of articles were screaming, absolutely screaming that inflation was reaccelerating, and that these rate cuts were absolutely the wrong way to go, and that we would soon have to revert to rate hikes. The reason why this is a pretty bad way of going forward when it comes to, well, in my humble opinion, of course, again, if you look at inflation has a very bad habit of being sticky, as they say on television, and probably the worst times. And if you let inflation tell you where you should go afterwards, I mean, you probably would have been on the wrong side of the boat in July of 2008. If you like the Fed now, were letting inflation tell you where you would have to go next, you would be the sort of person that was yelling and screaming for rate hikes in 2008 during the build up to one of the most catastrophic crashes in history. Same thing in 2000. In the beginning of 2001, we had inflation go up to nearly the cycle highs, 3.7, and not long after we had just had it come down. Same thing in 1990, and again, three very, very different time frames. Three very different eras. But again, inflation tends to be going up, even in times where bad things are brewing. And that leads me to one of the main reasons why I'm bullish on TLT. And that is the idea of being data dependent. I'm sure you've heard the Fed speakers say they are data dependent and they're going to wait for the data to tell them what to do next. The problem with being data dependent is that it is like saying, I'm going to wait before I smell like rotten eggs before having a shower. If you're waiting that long, you're probably going to be late. Okay? Now, arguably, people calling for rate cuts in the face of any pockets of weakness have been wrong. Okay, let's take the growth scare we had in August. right now, it is very easy to say that was a mistake. And in fact, I have no problems calling that consensus right now. It's pretty difficult to find anyone talk about in a positive light, put in a positive light the rate cuts that were put in place in September, November, and December. The problem is that, again, data dependence is looking for the past to give you answers. And whenever you're looking at the past, by definition, you're not looking forward. And if job quits are any indication, okay, at the very least, you have to make the argument that, well, we can make the argument that conditions have cooled significantly. Now, I'll be following this number a lot. As I said at the beginning, this is one of my favorite metrics to measure the conditions in the labor market. It's very simple. It's no magic formula. It's just the job quits number. And again, if we do see a sizable increase, that simply means that people are getting their mojo back, and we can expect inflation to go up simply because people will therefore have more income at their disposal, and that'll drive consumption. As of now, the trend is still in place, and if this continues, I would not be surprised that to see, say, in 6 months, inflation be between 2 and 2.5, and therefore bonds having to reprice rate cuts. And now that I mention it, the first rate cut is being priced in for, it's bobbing around between September and October. But actually, this has been quite a very good contrarian indicator when it comes to pricing and rate cuts. Because if you remember, exactly a year ago, December of 23, we were expecting rate cuts starting in March. Then we had exactly the bump that I was talking about before, which priced them out. Okay, we had that bump in January 24, and then with inflation going up up until March, and we priced rate cuts out. Then we had the growth scare. We priced them back in. Now we've had this year's seasonal bump, and we've priced them out again. And I would argue that now that they have completely been priced out, this is probably a good place to start nibbling at bonds. Again, not financial advice, but as long as conditions stay like this, I have no reason to be pessimistic about inflation. Will we have scares? We've just had one. Will we continue to have them? Probably. But again, I think it pays to have a more optimistic view on inflation, given the fact also that consensus is that the economy is fine. And I find myself on the same page as Neil Dutta of Renmac. Consensus right now is positive on economic growth, pessimistic view on inflation. I'll take the opposite. Simply because at these rates, and potentially having them pop up at, say, 5.2 on the 30, which, by the way, is exactly what happened in 2008 and 2007. Let me get this out of the way. We had a high, a smaller peak, drop, and then a second higher high. It's really, really similar. And it wouldn't surprise me a lot now. I'm not saying this is 2008 again. Of course, nobody nobody here is hoping for a 2008, I hope. Um, but again, it's very, very similar. And it wouldn't surprise me a lot to see 5.2 on, or even between 5.2 and 5.5 on the 30-year. But from this point on, as far as I'm concerned, the time I said non-financial advice, anything above 4.5 is really a price where bonds are undervalued. Especially, again, if you consider that we are at levels not seen since 2022, and we really don't have all the pressures of 2022. So I'll wrap it up there. I hope I made a good job of telling you where I sit. And again, if you enjoy this kind of content, consider leaving a like, and I'll see you next time. Bye.